Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, with John Mousseau, CEO, Director of Fixed Income, November 15th, just before the close this week. Indeed, a different week this week than last week on the equity side, and we'll jump over to John in a moment for some fixed income thoughts and ideas. Equities really headline driven. Last Friday we were focusing on the fact that most of the indices and many of the industries and sectors underneath were either at all-time highs or within spitting distance of all-time highs. Some of those areas got slammed this week with some of the headline news on nominations and political thoughts, political sparring and jarring. Unfortunately, there's a couple of the areas we like. Defense, tough week for defense, right? Some of that came on the back, most of that came on the back of fear of cutbacks within the Doge, D-O-G-E, Elon Musk and Vivek talking about cutbacks in budgets. As we know, defense companies rely heavily on government contracts. So some ugly price action in defense, specifically in some of the smaller contractors. We mentioned KBR last week, all-time highs, punished this week. Now, here's the decision as a portfolio manager. How do we react to that drawdown? Do we want to add or do we cut? It gave you no chance for a logical sell. So we're at an area right now where a name like that, and there's many of them in the defense area, on a run rate four quarters out is very inexpensive. Yes. You're talking about a company now trading at, and KBR we're talking about at a 16 forward PE, looks like 18, 19, 20% growth rate. But if there's going to be budget cuts, is the real growth rate 18, 19, 20%?
Right, and that's what you got to ask yourself.
That's what the market is trying to price in. What's worst case scenario? We know the growth's outstanding, but is it trimmed? And we're going to have to work through that. Position sizing is always important. It's vital to size your positions correctly. Fortunately, that's a small position. It won't have a large effect on the bottom line day to day within tactical trading, for example. Some of the areas that traded well this week were some of the semi-defensive cash flow heavy, right? Berkshire up this week when the rest of the market's off a couple of percent. So be interesting over the next couple of weeks. The market needed a pullback, especially in the broad indices. If you look at the NASDAQ 100, you look at the S&P, even the Russell, which is taking it on the chin a little bit, that's the small cap index, the Russell 2000. If you take a look at them on a chart, whether it's a Bloomberg chart, a point and figure chart, whatever type of chart you'd like, they were begging for just a reasonable pullback. Quite overbought last week, and we've gotten that. So reasonable, nothing surprising there. But let's see under the hood of those indices what sectors got mispriced this week, and that's maybe where we want to put some capital to work.
Sure.
How about on bonds, Moose?
Well, this was a week where you saw the 10-year Treasury move up 10 basis points. We're at a 440 this afternoon. It was at a 430 last week. It was as high as a 450 earlier today when it kind of regained its footing because of the turmoil in the stock markets. Interestingly enough, on the tax-free side, yields were down about 5 basis points this week if you looked at the scales and think about a 10-year AAA bond going from a 3 to a 295. That's because a lot of supply was already built in ahead of the election. What was interesting this week, though, is the fact that you did have this rise in yields. It's still dominated by the politics that are out there. Because if you looked at the numbers this week, you had CPI, came in right as expected. PPI came in right as expected, so 0.2 and 0.3. You had retail sales this week. A little stronger than expected, but takeout autos weaker than expected. So, it's not the economic numbers driving it. It is the fact that you now have a confirmed House, Senate, and White House all on the same side. and it is that fear that has driven the market up. We would suggest the bond market is kind of on the cheap side, certainly compared to inflation. We have one chart that just we'll put up, and it shows you the 10-year bond yield going back to basically the middle of June to now. We have seen variations of this chart before. Here, the important point is that yields were high, almost around a 450, 445, back after that disastrous debate, and it looked like you were going to see a Republican sweep. Yields went all the way down in the summer as Harris kind of came back, turned around. You were basically back to where you were then. And not a lot has changed. Some of the numbers are a little softer. So, it's really charting from where we are. This is not like we are a heck of a lot higher than we were in midsummer, because we're not.
Yeah.
So, we look at it and say, hey, the Fed's favorite measure of inflation is the PCE. That's running around 2.1. And you take a 10-year bond at a 4.4, that is a heck of a lot higher. And you only have to go back to the days of COVID with 0% almost interest rates.
Yeah.
And it's a different story.
I was talking to a couple of traders today on the fixed income side. How long has it been, John, since your real yield has been 200 basis points plus? And the way and you can call it all, there's jargon, but what I like to call it is your real yield in your pocket. And that is the 10-year Treasury at a 440, 445, minus John's PCE note at a 2.1. Let's jack that up to 2.5.
Yeah.
You're talking about 200 basis points above. That's what I define as real yield. Yield in your pocket, net of inflation. We went a decade without seeing it.
It's more attractive than it's been in a long time.
Yeah. So I agree with you. I think there's some value in bonds right now. I think there's some value in equities as long as we're looking for mispriced equities. I mentioned defense. I'll throw one more at you. Kennedy nominated as for the Health and Human Services. Biotech, pharmaceuticals, taking it on the chin today. You're talking about some wonderful companies. They're not all just vaccine companies that he tends to have a soapbox on. You're talking about companies that are solving human disease.
Right.
Some of them down 4, 5, 6, 8, 10% today on that nomination. We'll wait and see, is that a mispriced opportunity? If so, one of our holdings. We'll take a peek at one of our holdings in tactical trend. Vertex, VRTX. Has solved the underlying issue of cystic fibrosis. Has multiple other drugs in line. Down 5% today.
And look, I think it's important to remember that these companies, and one was a spin-off, right? But some of these companies have been around for decades.
Yeah.
A heck of a lot longer than Robert Kennedy's been on the scene.
Yeah. So we won't be able to tell on Monday. We won't be able to tell on Wednesday. But over time, as the market adjusts to both headlines and reality, we're going to find some opportunity.
Absolutely.
Enjoy the weekend. We'll see you next Friday.